Hello and welcome back to the channel. If you're joining us for the first time, please consider hitting that subscribe button and ring the bell icon. This way, you'll stay updated with our daily insights designed to help you navigate the world of finance. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." We started our video with this powerful quote because it perfectly aligns with our topic today. 12 amazing finance lessons that transformed my live forever. You are losing big. These 12 lessons are crucial for anyone serious about achieving financial success. Whether you're just starting out or looking to fine-tune your financial strategy, these insights will help you build wealth and avoid costly mistakes. But that's not all. Stick around until the end, because we have two amazing bonuses for you. A comprehensive takeaway section that sums up all the key points and practical exercises to help you implement these lessons effectively. You won't want to miss these exclusive insights. So, get ready to take notes and let's dive in. 1. Master delayed gratification. One of the most powerful financial habits you can develop is mastering delayed gratification. Imagine this. You're eyeing the latest smartphone that costs $1,000. Instead of buying it on impulse, you decide to save that money. Over time, if you invest that $1,000 in a stock market fund with an average annual return of 7%, in 30 years, that amount could grow to nearly $8,000. Delaying gratification means prioritizing long-term benefits over short-term pleasures. Whether it's waiting to buy that gadget, holding off on a vacation, or investing rather than spending, practicing delayed gratification leads to greater financial stability and wealth accumulation. What's the longest you've waited to buy something you really wanted, and was it worth the wait? 2. Keep tabs on key financial metrics. To take control of your finances, you need to monitor your expenses, savings rate, and net worth. What I like to call the Big Three. Start by tracking all your monthly expenses. Apps like Mint or YNAB can help you categorize and understand where your money is going. Next, calculate your savings rate, the percentage of your income that you save. Aim to save at least 20% of your income. But if you're just starting, even 10% is a good target. Finally, keep a running total of your net worth by subtracting your liabilities from your assets. Tracking these metrics not only keeps you informed, but also motivates you to improve your financial health over time. Do you regularly track your expenses, savings rate, and net worth? How has it helped you? 3. Simplify your investment strategy. Many people make the mistake of overcomplicating their investment portfolios. Let's take Sarah as an example. She initially invested in 15 different ETFs and stocks, thinking more meant better diversification. However, she found herself overwhelmed, and her portfolio had many overlapping investments. By consolidating into 3 well-chosen index funds, covering the S&P 500, international markets, and bonds, she achieved adequate diversification with less hassle. This simplified approach not only made her investments easier to manage, but also improved her returns. Remember, less is often more in investing. Stick to a few broad-based index funds to keep things simple and effective. 4. Be wary of depreciating assets. We all love new gadgets, cars, and luxury items, but they often lose value quickly. Let's consider John, who bought a brand new car for $30,000. Within 3 years, the car's value dropped to $18,000, a $12,000 loss. Instead of financing a new car, consider buying a certified pre-owned vehicle, which depreciates less and offers more value. The same goes for electronics and furniture. Financing depreciating assets can be a financial trap, as you end up paying interest on something that's losing value. Make smarter choices by investing in items that retain value or appreciate over time, like real estate or quality tools that enhance your productivity. How do you decide whether to buy something new or used? Share with us in the comments so everybody can learn from it. 5. Commit to long-term investing. Long-term investing is your best bet for building wealth. Consider the example of investing $10,000 in the S&P 500 in 1990. By 2020, that investment would have grown to over $130,000, assuming a 10% annual return. The key to long-term investing is to stay the course through market ups and downs. Don't let short-term volatility scare you out of the market. For instance, during the 2008 financial crisis, many investors panicked and sold their stocks at a loss. However, those who remained invested and continued to buy more shares during the downturn saw significant gains in the following years. Keep a long-term perspective, continue to invest regularly, and you'll likely see positive returns over time. Remember, time in the market beats timing the market. 6. Save aggressively early on. Early in your career, focus on saving aggressively. Let's take Emily as an example. She started saving $500 a month at age 25. By the time she was 35, she had accumulated $60,000, not including interest. This initial nest egg provided a solid foundation for her investments to grow over the next few decades. The power of compound interest means that the money you save and invest early on has more time to grow and molescently. The earlier you start saving, the more time your money has to compound and grow. Make saving a priority, even if it means living a bit frugally in your younger years. Sacrificing some luxuries now can lead to significant financial rewards in the future. Setting up automatic transfers to your savings account or retirement fund can help you stay disciplined and consistent in your savings efforts. How do you stay motivated to save aggressively when there are so many temptations to spend? What motivates you the most? 7. Keep investments boring. Boring investments are often the most successful. Think of Warren Buffett's strategy. He invests in solid, stable companies and holds them for the long term. Instead of chasing the latest hot stock or engaging in risky day trading, focus on building a diversified portfolio of index funds. For example, investing in an S&P 500 index fund gives you exposure to 500 of the largest U.S. companies, providing diversification and stability. This approach may not be exciting, but it's reliable and proven to yield substantial returns over time. Aim for steady, average returns and watch your wealth grow. Remember, the goal of investing is to build long-term wealth, not to get rich quick. The stock market can be unpredictable in the short term, but a disciplined, long-term approach can help you achieve your financial goals. 8. Focus on your own journey. It's easy to get caught up in comparing your financial progress to others, especially in the age of social media. Remember, everyone's financial situation is different. Avoid the trap of comparison and instead focus on your own goals. Use tools like budgeting apps and financial planners to track your progress and stay motivated. For instance, you might see a friend posting about their new luxury car on social media, but you don't know if they financed it with high-interest debt. Instead of feeling pressured to keep up, focus on your own financial goals, such as saving for a down payment on a home or building an emergency fund. By keeping your eyes on your own path, you'll make better financial decisions that are right for you. Celebrate your own milestones and progress, no matter how small they may seem. Remember, personal finance is a marathon, not a sprint. How do you avoid comparing your financial progress to others, especially on social media? As this is something a lot of people are struggling with, share with us your experience so everybody can learn from it. 9. Avoid lifestyle inflation. Avoiding lifestyle inflation is crucial to maintaining financial health. Picture Mark, who received a significant salary increase. Instead of upgrading his lifestyle, he continued living within his previous means and invested the extra income. This allowed him to save more and invest in his future. Lifestyle inflation, or increasing your spending as your income grows, can prevent you from achieving financial goals. For example, if you get a $10,000 raise and immediately upgrade your car or move to a more expensive apartment, you may find yourself in the same financial situation despite earning more. Stick to your budget, save and invest any extra income, and resist the urge to splurge just because you're earning more. This disciplined approach ensures that your financial growth isn't hindered by unnecessary expenses. Consider allocating a portion of any salary increases towards savings, investments, or paying off debt, and enjoy a small percentage for discretionary spending to reward yourself. 10. Know your risk tolerance. Understanding your risk profile is essential for making sound financial decisions. Everyone has a different risk tolerance based on their financial situation, goals, and personality. For example, a young professional with a stable income might be comfortable taking on higher risk investments like stocks, while someone nearing retirement may prefer the safety of bonds. Always evaluate financial advice through the lens of your risk tolerance. For instance, while investing in high-growth tech stocks might be profitable for some, it could be too volatile for others. Use tools like risk assessment questionnaires or consult with a financial advisor to determine your risk profile. This helps ensure that your investment strategy aligns with your comfort level and financial goals, leading to more consistent and stress-free growth. What one most important advice would you give to someone trying to understand their own risk tolerance? 11. Buy time with money. Using money to buy time can significantly enhance your quality of life. For example, outsourcing tasks you don't enjoy, such as tax preparation or yard work, can free up your schedule for more fulfilling activities. Let's take Lisa, who hated doing her own taxes. She decided to hire an accountant, costing her $300. This decision saved her hours of stress and allowed her to focus on her freelance graphic design work, which earned her $1,000 in that same time. Similarly, hiring a lawn service can free up your weekends for hobbies, family time, or even starting a side business. This approach not only improves your life satisfaction, but can also lead to greater income and personal fulfillment by allowing you to focus on what you do best. What's one thing you'd love to outsource but haven't yet, and why? 12. Choose your life partner wisely. Your life partner significantly influences your financial journey. Marrying someone with similar financial goals and values can set a solid foundation for long-term success. For example, if both partners prioritize saving and investing, they can work together to build wealth and achieve financial stability. On the other hand, differing financial habits, such as one partner being a spender while the other is a saver, can lead to conflicts and financial strain. Take the time to discuss your financial goals, spending habits, and debt situations before committing to a long-term relationship. This mutual understanding can help prevent misunderstandings and ensure that you both work towards common financial objectives. A partner who shares your financial mindset not only supports your goals, but also contributes to a harmonious and prosperous future together. If you want to learn more details about simplifying your investment strategy and more, then click on the screen and check out 12 takeaways and exercises that will help you implement all the strategies in life. See you in the next video.